And Jeff, everyone's focused on the Fed this week, of course, what we should be expecting from Jay Powell. Do you think we get anything different from what we've already heard? Let's start there.
Interesting question. I think we might hear different things. I think Jay is going to try and convince us that rising rates aren't such a bad thing. I think that unlike Christine Lagarde at the ECB, who was a little worried, so they might take some action in the intermediate term to tamp down the rise on yields, I think Jay Powell may say something similar to what we heard from Governor Bailey at the Bank of England, which is rising rates validate the fact that everything's working, that the stimulus is actually working to lift economic growth and to bring inflation towards their target point. So I don't think we're going to hear anything dramatically different from Chairman Powell, and that could erase some of the momentum that's been behind the dollar lately.
So this is interesting, Jeff. I want to get your thoughts there as the dollar continues to find support just when it looks like it's about to break down. Walk me through, again, that kind of connection between the dollar and possibly what we might hear from the Fed chief.
Sure. Well, a lot of what comes down to the movements between currencies are short-term interest rates, essentially the return you get on your cash. And that has a lot to do with where the central bank's policy rate is. And the idea that the Fed was going to be the first to move interest rates as soon as next year, raise them, meant, well, you might make more on your dollar cash than you would on your euro cash or your yen cash. But that edge might be eroded. I think that Chairman Powell might push back on the idea that they'd be very quick to raise interest rates, even in the face of improving economic growth and massive fiscal stimulus. I think they changed the framework last year, essentially saying they're willing to let the economy run hot for quite a while before considering raising interest rates. We'll get that dot plot from the Fed, which will give the central tendency of what the members of the FOMC are thinking about rising interest rates. My guess is that will still be pushed out to somewhere in 2023, where we get that first rate hike, similar perhaps to what we might see from the Bank of England or the European Central Bank. Again, erasing that differential that's kind of led the dollar to rise here in the near term, the idea that cash rates might be a bit higher sooner than they are elsewhere.
So thinking about this relationship between the U.S. and elsewhere, right now we've got our vaccines going out at a pretty nice clip, pretty impressive compared to the rest of the world. But that being said, there are some complications with the U.S. stock market, given the tech weakness has basically kept the S&P kind of pinned at the same level now, as we are technically making highs, but a lot more pronounced in the small caps. Jeff, what about when we look at the rest of the world, the overall global equity situation? How does it look comparably?
You know, it's remarkable how similar the returns are. The German DAX is up about 5 or 6%, same as the S&P 500. The European, the Euro Stoxx 50, about the same. The Hang Seng, China, about the same, 5 or 6%. The UK stock market, about the same. So it doesn't even seem to be tied back to this pace of vaccinations. You know, if you were looking merely at vaccinations and reopenings, you'd say, well, the UK and the US seem to be doing the best, yet their returns are very similar to Europe and China, which are very much lagging on the vaccination front. I think this gets back to economic reopening and the idea that whatever the pace is here in the near term, that'll even out in the second half of this year. We'll see a broader global reopening. And even interest rates, as they've been climbing here lately, haven't derailed that idea of an economic rebound. The rise to rates here, 1.6%, doesn't seem to be slowing M&A deals. We've heard more this morning, nor has it slowed down investment in capacity or equipment or hiring by firms over the last few months. So that's a good sign that the recovery remains intact, even with these rising rates, as we're seeing them around the world.
Jeff, you got a good chart for a Monday to kick us off in a good mood. It looks like a bunny bounce in the markets. What are we looking at here, Jeff?
Yeah, I think this is it's not a bull market, not a bear market, maybe more of a bunny market. And yes, I did draw that bunny. We've been hopping along this year, kind of getting excited about economic momentum, jumping to the upside, and then worried about rising rates and concerns about losing some of the stimulus on monetary policy that could continue in the near term. But I think ultimately we break free of this. The bunny gets to escape velocity and worries about rising interest rates begin to fade, and more of the momentum around this returning economic growth comes into play. And so I think, again, maybe this month, maybe next month, we're still hopping. But I think in the second half of this year, we see more of an upward trajectory.
Okay, I never had a rabbit as a kid, but from those who did, from what I understand, they can be a little bit of a mess too. So let's hope it doesn't cut that way. Jeff, what about the economic data around the world? You're looking at a pretty interesting data point this morning that's picking up the pace as we also look at kind of ups and downs on the chart. The Japan machine tool orders, is this like a durable goods from the Japanese economy?
Exactly right. So we're going to get durable goods in next week here in the U.S., and that should show us some good things. But Japan is the world's durable good producer. They make so much equipment, from semiconductor capital equipment to auto producing equipment to earth moving equipment. It's an important place to watch. Those orders jumped 37% in February from a year ago, beating economists' expectations. And as you can see here, the fastest pace in 3 years. This is a really good sign that businesses are still investing despite higher rates. And that's critical. There are a number of worries about this. You know, we're seeing the same thing in Germany. You know, we're getting a good surveys of German business optimism, investment in Germany. So we're seeing it in Europe, seeing it in Asia, seeing it in the U.S., not yet anywhere near derailing this recovery.
Okay, so generally we see unison, that kind of synchronization for the most part around the world here. It does kind of remind me the last time we were talking about higher rates, right, which was early 2018, late 17, the synchronized growth phenomenon then that was kind of disappointing ultimately, but didn't stop some of the rate hikes from happening. Jeff, the last thing you got, another chart for us this morning, is looking at M&A implementation that's been happening. A lot of deal pickup in terms of the number of deals. What does this mean to you?
Well, I think, again, we've seen these jitters around interest rates and what it might do to the economy, but we're seeing businesses willing to get together. And even though these deals can sometimes be costly, sometimes involve a lot of borrowing, we're seeing here on track here for the latest quarter. I know there's a lot of data on this chart, but if you look to the latest quarter, we are tracking to one of the strongest quarters for M&A ever seen. It's among the highest, and certainly in terms of deal count, it may actually end up being the highest. And that's, I think, really important here. Business leaders aren't concerned about this rise in rates, derailing their plans to get together. I know a lot of these deals have been in the works for a little while, but they haven't been derailed. And that's an encouraging sign that businesses continue to be optimistic in their outlook, continue to invest, continue to come together in an environment of physical distancing. Corporations are doing the opposite. So again, I just want to reiterate, business leaders, whether it's investment in capital or investment in mergers, are still seeing this positive environment despite the higher rates. I think that's encouraging. So even though the market's hopping along, I think underneath that trend is one of continued investment that may lead to a self-sustaining recovery.